Good afternoon, and thank you for joining us for our sixth installment of our Inclusive Financing webinar series. My name is Wesley Holmes. I'm the Director of Strategy and Development for the Southeast Energy Efficiency Alliance. Today we're going to be talking about the value and importance of establishing reserve funds to support inclusive financing across the region. I'm going to take us through the first few slides, kind of laying out the foundation for why we think this topic is important and what we're going to go through today. All right, so the question is, why is there interest in establishing reserve funds around the region? Well, it starts with opening up access to inclusive financing. And the reason that matters, particularly for those of us working at SEIA, is that the Southeast is actually home to some of the most pervasive and persistent poverty communities in the country, and have been for a long time. And a lot of the consumer credit laws actually prohibit financial institutions from being able to provide loans for energy efficiency investments, very needed energy efficiency investments, to a huge swath of our population across the Southeast because they don't have an adequate credit score, or a lack of adequate credit history, or any other numbers of barriers related to collateral and other things that just keep them out of the marketplace for energy efficiency financing. Now, utilities can play a very important role in this space. They are uniquely positioned. Cooperatives can step in and actually become financial institutions to a degree and actually provide no interest or low interest financing options for a lot of these customers who are otherwise left out of the marketplace. And this map pretty well paints a picture of the situation we're trying to address. This is all those deep swaths of red around the Southeast. Those are the most consistently persistent poverty areas around the region. And all of those are actually served by cooperative utilities. Now, what you're looking at here, this is a map of some of the cooperative leadership around the Southeast. The Southeast is actually, we're very fortunate to be home to the largest amount of on-bill financing programs available anywhere in the country. And all of that has been spurned by people are not seeing slides. Bring that back. Okay. Sorry about that error, folks. I hope everybody can now see the slides we're actually showing. So where we're at right now, this is actually, as I was saying, highlighting where the active on-bill financing programs are across the region. These are actually all spurned by recognition by the local leaders within these cooperatives in these areas that they had large segments of their service territory whose housing desperately needed investments in energy efficiency, and saw that they had really no other avenue for making those investments. And it's also worth noting that default rates on on-bill financing programs are actually remarkably low. Really, any variation of the offering, whether it's tariff-based, loan-based, or otherwise, actually have default rates of less than 0.1% across the board. Tariff performs better than, better than any other, actually, but there is actually still perception issues within the utility industry. While these have been successful where they've been deployed, there are still relatively few. Throughout the Southeast, there's about 20 to 25 on-bill financing programs made available throughout the region in some form or another. But that's actually pretty small. It's only about 10% of utilities around the region actually offering them. There's about 260 who are not making them available. And so with that kind of lack of programmatic history and well-established performance data, utility boards and utility leadership are traditionally very risk-averse and skeptical. They're shepherding other people's money, and they want to make sure they're making the most proper investments possible. And so there's a lot of reticence to do these, to make these programs available. And so there's an important role for other stakeholders to play in kind of helping to overcome those barriers of perceived risk. And that'll help kind of overcome the long-term hurdle of giving a proven data set so that utilities see that these are as safe and as secure as any other investments they make, and in many cases, safer. Now, so what does a reserve fund offer to a utility? It provides a measure of assurance that the utility can file a claim for any charge-offs resulting from non-payment of a cost recovery charge. So if a utility makes investments in a property and a person either moves or the house is irreparably damaged or destroyed, or they move away and they're unable to recover their costs through other means, a loss reserve or reserve fund rather can actually kind of close that gap and give them the security knowing that at least up to a certain amount as they're getting started, whatever risk they put out, they're covered in case of losses there. This also has the dual effect of, because they have that security, it then creates conditions where utilities can actually dramatically increase the level of investment they're willing to make into these programs. Now, for broadly, in addition to making things easier on the utility, these reserve funds also have value to the marketplace itself. They're expanding access for energy efficiency upgrades to markets that otherwise never had access into before. They're reaching marketplaces or market segments that otherwise were left out. So you're suddenly able to bring in renters and fixed income and low income and municipal governments, and you're really catalyzing investment in housing and infrastructure, which is jobs. Where tariffed on-bill financing has been made available throughout the Southeast, all of them have had between $1 million and $1.5 million or more of direct investment going into their communities. That's a lot of jobs, there's a lot of labor, that's a lot of products being sold and manufactured. Now, the value to the state is that, one, this creates an opportunity for state energy offices around the region to increase their connectivity with their cooperative utility space. It allows them to find access and create a data set of energy performance in their rural housing sector. And it also supports meeting their energy management goals for the state broadly, which is why we're very happy to be joined by actually a number of state energy offices from around the Southeast who are all looking at ways that they can help establish a reserve fund so that they can further incentivize the cooperatives in their territory to make more of these programs available. So we're very happy to be joined by all those folks and very appreciative that they're exploring ways for them to expand this market opportunity. So to take us through kind of the process today and help us understand how folks navigate creating a reserve fund, I'm going to turn things over now to Dr. Holmes Hummel, who's one of the region's leading experts on these models and designs, and she's going to take us through the structured logic process for how to design a reserve fund.
Thank you, Wesley, and good afternoon, everyone. Wesley, I've got an echo. I just want to make sure the sound quality works for you.
I can hear you fine on my end. I'll go on mute on my end so there's no feedback from me.
Okay, great. Good afternoon, everyone. I'm thrilled to be joining you for this session, and I want to acknowledge some of you have been with the Learning Circle series since January, so you are now operating at a 301 graduate level for inclusive financing and program development and design. Some of you are actually joining this conversation relatively recently because of your interest in financing instruments and reducing risk exposure to investors who can develop large portfolios of financial transactions that reach market segments that have been long underserved. So for those of you who are relatively new, I'll encourage you to take advantage of the earlier programming recorded by SIA that's a part of this series. And for those of you that have been with us from the beginning, be active in making sure you're getting the most out of this session with the Q&A that follows. This section that we're entering now, called Applying Structured Logic to Design a Reserve Fund, is going to bring us through 4 slides that preview a series of sequenced questions. That's your opportunity to think linearly about how you would go through the process of cultivating a program design for a reserve fund, and then we're going to switch gears to actually show you one that's a prototype as a result of this process. Wesley, advance this one slide to take us to the set of questions that any of you could ask a utility executive as you are starting to think about how to mitigate the risk that they perceive is associated with an inclusive financing program. the first thing to do is ask them about their business as it operates today. So you're giving them a chance, instead of jumping into something that's new or something that they haven't done before, to ask them questions about what they know well about how their business operates now. For example, every utility executive does know what steps they need to take at a corporate level before they are able to declare an account delinquent and even take the steps for executing disconnection for non-payment. There are standard procedures for that, and they know what they are. They also know what they do to resolve those situations. They know how often they occur each year. They know how much money they amount to at the end of the year, and what their finance department records at the end of each fiscal year as being the amount that they charged off of their balance sheet as being revenue they expected but didn't collect. Overall, you will find that utility executives are knowledgeable about the amount that they charge off each year, and that it's typically less than 0.5% and sometimes less than half of that. So they're familiar with the business model of tariff-based investments and cost recovery on the bill. They're also familiar with the risk exposure they face in their mainline business of not actually collecting the money that they expect. That's ultimately the heart of the perceived risk associated with an inclusive financing program. A utility executive might say, look, I understand what's happening here, but my board members have some trepidation. They're not certain what will occur if we put $1 million into a distributed portfolio of energy efficiency upgrades. Will we get all of our money back? And what happens if we don't? So the first thing we do is ask them to tell us more about the systems they use today. They're already meeting their expectations and satisfying their risk management requirements for their oversight boards. Wesley, take us to the next set of questions. There you go. The second set of questions allows us to surface for those same utility executives the types of questions that they would want to do due diligence on themselves, but instead of making all of them go out and do independent research, you've got here from the Southeast Energy Efficiency Alliance a set of answers that reflect the experience in the field reported by utilities that already offer inclusive financing programs. So across the board, utilities in Kansas, Kentucky, North Carolina, Arkansas, and New Hampshire all together have reported that collectively they've invested more than $25 million through tariffed on-bill programs, and that's only looking at the utilities that have used the pay-as-you-save system, which allows us to compare apples to apples. Typically among the residential portfolio, which is where utility executives do describe their greatest concern about risk exposure compared to, for example, their institutional or municipal or commercial customers, they tend to be concerned about their low-income customers with regard to cost recovery. We've seen these same utilities record remarkably similar figures for what their average investment is per site. It's typically $6,000 to $8,000 per site with a cost recovery period of 10 to 12 years. And because the largest amount of money that they could lose occurs on the first day of the investment, and then month after month as they're recovering their cost, their risk exposure declines because, well, they have less money left to recover on each investment for each billing cycle where they're receiving revenues. You could imagine that they might experience more claims or more write-downs in the future as the investments age because, oh, well, the equipment ages and then maybe something breaks down or maybe something goes wrong. So you think to yourself, well, the consequence is decreasing from the very first day you make the investment. Your consequences are always getting lower, but the probability of something going wrong may be going up. And what you're seeing here from the utility executives that have these programs is that they're not observing higher risk exposure as their programs are maturing. So they're entering year 7, year 8. They're not seeing the frequency of claims rise. Overall, these utility executives have reported what Wesley has already explained, a tariffed on-bill program portfolio level charge-off rate of less than 0.1%. Put another way, that means their cost recovery figures are above 99.9%, typically better than the performance they expect every year from their mainline business and electricity sales, which was one of the questions that we looked at previously. Now, Wesley, move us ahead one more slide to stick with the experience in the field, because we want to talk about what happens when. What happens when a utility experiences a charge-off? What's the underlying cause of that? So there is data available, but at the scale that charge-offs are occurring, every program operator that we've had a chance to reach describes them in almost anecdotal terms. There's not a large enough data set to describe it. 50% of all charge-offs are attributed to such and such a cause. A utility in Kansas put in several investments right on the eve of the mortgage market meltdown that took several of the homes that they had invested in into foreclosure. Well, a bank that ended up having ownership stakes in several of those houses found that their utility bills had a line item on them that they wanted to clarify for future buyers to make it easier to sell the house. They came to the utility and essentially negotiated a settlement that relieved them of making payments on their outstanding obligations. It turned out to be an accommodation for customer service reasons. Nothing had gone wrong with the upgrades. The energy efficiency technology was still performing, and the future buyers got the benefit of all of the savings. It's important to know why and how a charge-off is being called for. And there's a difference between customer service considerations, which you see here as a distinguished aspect of the second question, and whether or not the customer just left town and just put the keys in the box and never paid, or if the HVAC system failed. What we are seeing is that the utilities are not reporting charge-offs due to the failure of the equipment in any frequency that we can detect. The program operators are not saying, well, we had to report a charge-off because the air conditioner quit and we couldn't fix it. You know, some sort of warranty issue came up, so on and so forth. That's actually to be expected if you are familiar with the residential energy efficiency space. The overall rate of equipment breakdown is not going to be higher in an inclusive financing program than it is generally speaking across the marketplace. And for that reason, there are insurance companies that are willing to sell insurance policies to utility executives who feel like they cannot bear the possibility that they will be faced with charge-offs due to equipment breakdown. But in every single case that I've worked with a utility to price that option and consider it, ultimately, the utility executive realizes the risk is actually very low, and they'd be better off not paying for the insurance policy and just paying for the charge-offs. Let's move ahead to the next section, Wesley. That's where you start to see the utility executive dig into their own circumstances. This is when the utility executive is using the financial analysis that they have developed for an inclusive financing program to help them gauge the scale of exposure they would possibly have if they launched a tariffed on-bill program that reached, say, 2% of their households per year. So these set of questions, which I won't go through in the same pacing as the last two, you can read them on the page yourself, will give you a sense of a utility executive who's trying to say, how big is a bread box? How big is this investment portfolio that I'm thinking about developing as a new value-added service that I can bring to my customers? Because the scale of that portfolio also helps them scale the size of a reserve fund. I'll ask you to move forward, Wesley, to the fourth section. Here's where we get into the specific attributes of a reserve fund itself. Those of you who have been involved in on-bill loan programs and possibly in the design and development of a loan loss reserve will recognize that some of these terms are very familiar. First of all, you need to know where your source of capital is coming from. And when it gets there, you need to know who's literally going to be responsible for tending it as a custodian and who's going to be responsible for dispersing it, literally writing the checks out of that account. You need to know who will be eligible to receive checks out of that account, meaning which utilities will be eligible to make claims on the reserve fund. And you don't want to hear from them just when they have a problem. You want to be hearing from the utilities that are participating periodically so that you can see how the portfolio is actually developing in the field. Once a utility signs up for the reserve fund, you don't want to double promise the money to somebody else. So the obligation terms allow you to keep track of how many utilities are involved in your reserve fund and how much activity they are actually stirring out in the field, so that you know when you're at the end of your rope, when your reserve fund is fully subscribed, fully obligated by your subscribers. Now, those subscribers, the utilities that have opted into the reserve fund and they've been out in the field busily making investments and letting you know how they're getting along, may come in during their periodic reporting and say, oh, I have a claim. We've had a charge-off for a reason that's one of the eligible reasons, and they need to know who they're sending that claim to. Of course, the administrator that was already been determined to be standing by, say, 4 times a year or 2 times a year, receives that claim, processes it, and sends out a disbursement. The disbursement process is very similar to what you might imagine an auto insurance agent does for a fender bender, where they're receiving information. They say, I see you have a claim and it has such and such a value. You've been a subscriber. You're in the system. Here is the amount that we can reimburse you for that, and sends the check in the mail. Now, the utility is on Scout's honor for making claims that can be validated, because surely there'll be a provision for periodic checks or cross-examination, something that will keep people honest and, of course, protect the reserve fund from fraudulent claims. There's never been even an anecdotal report of a reserve fund being defrauded, but it's good practice to have the terms in your reserve fund design to make sure that everyone understands the integrity it's important to protect. At some point or another, the utilities may decide that they don't need the training wheels anymore. They understand how to manage the risk exposure in a highly diversified portfolio of small-scale investments that they're making in highly performing investments like energy efficiency upgrades using mature technologies. But they all do need the option to exit. And the termination of the subscription can happen either way, from either the fund providers and fund managers' perspective that may need to close the fund, or the utility that may find that it's ready to withdraw, it may not offer the program anymore, or may use a different program altogether. And at the very end, a process for dissolution, because the reserve fund itself is not an immortal entity, and for good contracting purposes, you want to negotiate those terms. I've talked through now the 3 sets of questions that allow you to frame an informed discussion about the attributes of your fund, and in one slide, I've given you a picture of the structure of the attributes of a reserve fund that you would want to negotiate with your participants. And now, Wesley, if you bring us to the last part of today's discussion before we do the Q&A, I want to show you an example. Go right ahead to the example. So we were privileged to work with a state energy office in the Southeast that's a front runner in this field. They had $500,000 that they were ready to commit, and they realized that because it had come to them from sources that had some terms attached, taxpayer funds that had some terms attached, that they would need to remain the custodian of the account. But they did first explore whether or not a local CDFI would be a good partner for them. And that CDFI was in a very good position because of their experience managing loan loss reserves. They were interested and they were in a position to be a capable administrator. In the end, because of the source of capital, the state energy office thought it would be best for them to manage the account. They offered, or planned to offer, the reserve fund to electric cooperatives specifically to start, for 2 reasons. One, the electric cooperatives in their state were leading the way on offering inclusive financing as an innovation in the field for that state, and also because their cooperatives were serving counties in their state that had the most endemic conditions of poverty, and obviously had had the biggest challenges to face for bringing energy efficiency investments into those markets because the customers there lacked access to capital. Now, they structured the entryway into the reserve fund on a first-come, first-served basis in order to motivate the utilities in their state to move quickly to get to the front of the line. This helped sort out the movers and shakers and highly motivated executives from the people who wanted to take a fast follower position or a wait-and-see position. They decided they did not want to see reporting more than twice a year, because they didn't need to go through paperwork procedures more than twice a year. And that suited folks that they were talking with the consulting at the time. They knew that the reserve fund size could be 1,000 to 1 if they expected their subscribers' inclusive financing programs to work as well as the ones in Kansas and Kentucky and New Hampshire. That would be 1,000 to 1. 0.1% charge-offs on 100% is 1,000 to 1 leverage. So they were extremely conservative by saying, well, we think that our reserve fund is going to be 10 times larger than the field average to be sure that we have enough money to cover the charge-offs that might occur. Wesley, take us to the next page. Once they had thought through how they wanted to set up their reserve fund, they turned their attention to how they would actually undertake the activity of the reserve fund, which is really paying out the claims. Well, here it is. They said, well, we'll pay out claims for proven technologies. If you try a technology that really doesn't have a good track record, we don't want to be using this reserve fund to be providing technology insurance. It's not an R&D program. So we want to see proven technologies in the field. For anyone who's worked in building energy retrofits, anything that is in a technical reference manual for your state would fall into this category of proven technologies, proven upgrades like insulation or air sealing, duct sealing, HVAC. They wanted to include both commercial and residential classes. They were keen to make sure that schools, municipal buildings, congregations, nonprofits, and other people that have struggled to access capital would be able to participate. They agreed that they would settle the charge-offs once per year, which was consistent with the frequency with which their utilities were actually settling charge-offs on their own books. So once every fiscal year, the utility would write down its charge-offs, and that would be the point at which they would file a claim. They would plan to disperse the reserve funds until it was depleted, and they would require the utility to take a first loss position that was equivalent to 0.1% in order to make sure that the utility managers were taking responsibility for managing their programs at least as well as everybody else in the field. In other words, they said this reserve fund is for utility managers whose programs, for whatever reason, aren't performing as well as the prevailing performance in the field. This makes the utility executives motivated to at least reach an average benchmark of 0.1% of expected program revenue being foregone each year by whatever may befall them. It also minimizes the amount of churn in the claims process until you get to a point where you overcome your deductible and you need to come in for reimbursement. Now, they also wanted to make sure that a community college with a big lighting project didn't come in and gobble up a big chunk of the reserve fund. So similar to other risk mitigation pools, they put a maximum claim of $25,000 for any one project. And for a single subscriber, they decided they didn't want one utility to come and hog more than a fifth of their reserve fund. So they put a cap. They said, look, you can be in our program, but once you get to claims of $100,000, you should know enough about how to manage that portfolio to be on your own. And the last piece to cover about how the sample profile worked out was they decided that they would incentivize the utilities in their state to join the reserve fund and gain experience making investments for a period of 5 years, up to 2022 or 23. But they would no longer take new subscribers or new obligations past 2022 and 23, letting their utilities know that the period of learning is now. And if you come in after 2022, 2023, You'll need to learn from the field and not learn with the benefit of this support system from the taxpayers. But we will keep the fund open for the whole period of time that it remains exposed to claims, so that those that have already obligated funds will still be able to make claims up until 12 years after the fund stops taking new obligations. That brings us to the last page in today's program. It gives you a glossary for reference on terms that we've used today, ones that you can reference if you return to this presentation. And right here at the half-hour mark, I think we've met our objective, Wesley, of reserving half of today's time for dialogue and discussion with those of you who've tuned in to think about how this information might apply to the inclusive financing programs that you're striving to set up in the markets you serve. Wesley, back to you.
All right, thank you, Holmes. So next we'll now move it into questions from folks on the line. Feel free to use the question box on the dialog box down in the lower right-hand side and type in any questions you have. All right, one question I'll lead off is, Holmes, do you have any notion of, what is a process for a state or a manager of a reserve fund if there's, I guess, any skepticism regarding a claim?
That's a very good question, Wesley. That's one of the things to negotiate, where the administrator of the fund has an entitlement by virtue of the subscription agreement to cross-examine claims. And friends, you would want to see that in the structure of the reserve fund, not because you suspect people are bad or would do bad things, but that everyone wants to have confidence that the fund is well protected and operated with integrity. And so the fund administrator may be able to refer the claim for inspection. This allows them to retain, for example, someone who may be certified as a BPI building inspector who could travel to that site, or literally the right to retain a BPI inspector in any part of the state who's local to that site to go and make a visit to verify and validate the claims. Of course, that does cost money, and it might be a cost that the administrator takes as part of the operation of the fund. But it allows everyone to have confidence that a third party has inspected and validated the claim. Most of the time, however, Wesley, that's not necessary. Most of the time, the claims can be validated with literally iPhone pictures or data profiles from meter data or other types of evidence that can be easily stapled or attached to the claim that raise confidence in the administrator's mind that it's a validated claim. Now, to be clear, if the administrator suspects it's not a valid claim, dispatches a local inspector who's BPI certified that they can literally call on contract just for that purpose, and finds that it's an unfounded claim, it will be referred to the Attorney General's office if it is a state-managed reserve fund. And that is no fun for anyone. And so the utilities that subscribe to the reserve fund need to know that if they plan to submit a fraudulent claim or a claim that's unfounded and that's caught, they will be addressed by someone in the Attorney General's office who will be investigating. And that is typically enough deterrent for any utility executive to think twice, and certainly the finance managers that I've met in this field wouldn't have even thought about it the first time. But those are the provisions that are typically put in place to make sure everyone has confidence.
Great. Thank you, Holmes. Another question we have here, I guess this is in response to the glossary term. So when we say a maximum, when you define a maximum claim, is it the max claim per meter, or is it a max claim for a utility for a year?
Well, that's an excellent question. It's intended to mean for a meter, for a single investment.
Okay.
And what this does, just to dwell on it for a minute, what that does is it gives a utility executive a chance when they think about a project, and I'll use a community college because there's a good example of this in Arkansas, where currently 1/3 of the portfolio of the Ouachita Electric program is one project. And that utility manager really had to think about that. Do I want all of that money, 1/3 of my portfolio, in just one project? But in the end, they decided it was an excellent risk because the technology was solid-state lighting, which they had a high degree of confidence in. And also, it was literally thousands of solid-state lighting units, all the parking lot lights and stadium lights and things. And they thought to themselves, okay, what is the likelihood that any of these solid-state lighting pieces of equipment are going to fail? And how much would that ultimately be? It was not going to be the whole project. It's not like we bought one chiller that cost $500,000. We actually bought a very highly diversified set of upgrades at that one site, so we think we can manage that risk. But that's the kind of thinking process that that particular attribute of the reserve fund is designed to inspire, to encourage the utility executive to be thinking about their own process of risk management and understand that this is how they gain confidence in introducing a new product line into the value-added services they can offer their customers.
Thank you. So another question here. Can the utility be asked to, can they essentially ask for, I guess, backing in the fund for the amount that they have available to loan out, or can they only get backing for money that's actually been invested, been used?
That is an excellent question. Let me go back to the glossary terms of subscriber and obligation, subscription and obligation. When a utility subscribes, they haven't started making any investments, or maybe they have, but they're opting into the reserve fund for the first time. And so they want to communicate to the administrator, here are my intentions. I've got a $6 million program that I plan to deploy all capital for over the next 4 years. That would be an example. So that gives the administrator some idea of what the ultimate portfolio size may be, but that semi-annual reporting coming in every 6 months is actually telling the administrator what's actually been put at risk. Until the utility actually makes an investment, it's not at risk. And that's the money that ultimately then is obligated in the fund. So the reserve fund says, the reserve fund manager is looking out at the landscape and saying, okay, I see my utility executives are out there investing away. They're up to $1 million. They're up to $2 million. They're up to $3 million. When they get to a point where they're at 100 times the amount of money that I have in my reserve fund, I need to let them know that I won't be able to extend further coverage because we've maxed out what we agreed the terms of this reserve fund would be. Or alternatively, I could go out and raise more money and top off my reserve fund in order to give them more coverage for more investments. But that's why the semi-annual reporting is there, so that the reserve fund manager can keep track of how much is being obligated and see how much more of their reserve fund remains to be offered.
All right, thank you. One question here is asking if you could say more about other program costs for the tariff model. So things like marketing and customer acquisition, quality assurance. Holmes, we still have you?
Yes, Wesley. I'm sorry. I tapped the mute button to tap something else on my screen. Wesley, will you help me with this answer, because it sounds like that question pertains to the management of the inclusive financing program itself rather than the management of the reserve fund. Am I hearing you correctly, or do you want to ask that question in a different way?
No, I think that is a good interpretation of the question. It seems to be more along the lines of, I guess, the other kind of baked-in costs for delivering these programs. I guess, and to that amount, I would actually advise attendees to kind of go back to some of our earlier sessions in the series that look at the introduction and update on existing programs. The update on existing programs would actually be particularly valuable in this question, where we had presenters from 3 established programs around the region kind of highlighting what their experience as an administrator has been, what kind of costs they've incurred, rates of return, and overall, are they saving more than they're spending? And that gives you really good kind of in the weeds answers to that kind of question. So I'll defer you to refer to that resource. Now, another question here. Are most reserve funds in other states, are they using what they quoted as a deductible concept? I might ask the questioner to clarify what they mean by that, or Holmes, unless you know what they mean.
I do. No, I do. It's an excellent question. And the answer is, I think that there has been a trend towards using the deductible concept, typically discussed as risk sharing. So when you hear people talk about setting up a loss reserve or a loan loss reserve and they want to share risk with the utility, what they're trying to convey is they're not going to use taxpayer funds to absolve a utility manager of all risk, because it can inspire a kind of inattentiveness that can lead to decisions that may be perceived as reckless, but really it's just a result of inattention. And why wouldn't a utility manager go on and do other things with their day if they thought, hey, that portfolio is totally covered by the state taxpayers. I don't need to worry about that. If anything goes wrong, we'll just go to the taxpayers. You don't want to inspire a utility manager to do the rational thing and delegate away their risk management responsibilities. And that's why risk sharing does make sense, while still allowing that utility manager to have confidence that the performance of their program won't be worse than the average in the field, because you're just asking the manager to do as well as at least everybody else is reporting they're doing. And so you take responsibility for the first 0.1% of your investment portfolio, and we'll take care of things above that. Let me dwell here for one more minute to let you know that I've seen some reserve funds and loan loss reserves designed with what I'm going to call a collar, where they have both a deductible and a maximum claim like you've seen here, so that the utility manager has to reconcile themselves with, not only am I going to be able to file claims if I exceed a charge-off rate of 0.1% per year, but if my program is really poorly managed and we end up, losing money at an unprecedented rate, we are going to be responsible for that. And the state energy office is not going to come and bail us out. That's what helps keep the program in the line of sight of the utility managers who are in a position to manage it as responsibly as everything else that they oversee at their utility.
All right. So one of our other questions here is, what type of organizations typically provide capital to establish a reserve fund? Is it usually public funds or philanthropy dollars, or where can they come from?
Another excellent question. I have seen both, and I want to point out that the Recovery Act did stimulate a lot of conversation about loan loss reserves, broadening the conversation and introducing it to more state energy offices. Many of them did experiment with them. Some of them linked them to loan-based programs where the volume of transaction was relatively low, and now the state energy officers are thinking about repurposing that money for inclusive financing programs where the capital velocity might be higher. So that's a common thread for taxpayer-funded reserve funds, is that they have some lineage or relationship to conversations that were first seeded 5 years ago or more during the Recovery Act era. But also, it is undeniable that in the last 2 years, impact investors, and particularly philanthropists that are interested in impact investment in the clean energy space, have literally been scouring the landscape for a chance to put up money that could have this kind of multiple. 100 to 1, if they put up $100,000 and can get $10 million worth of private sector capital committed into the space, that's better than almost any grant they could make in the field. So we've seen actually requests come in from foundations. Can you place my money in a reserve fund? Do you know somebody who wants to set up a reserve fund where we could put our money in it? So both types of examples are now going to be more common.
Thank you, Holmes. So another question is, Can a reserve fund established for a tariff-based program be used to back or otherwise support other types of models, like a loan-based program or others?
We have a real group of ringers with us today, Wesley. These are outstanding questions. I want everyone to know the answer here is go back to the slide on attributes. And if, Wesley, you want to, you can just tap back one slide, I think. Let me just think about this for a second. Where will you see it best? Right there. Just stay right there. Yeah. The last line on this slide shows you your maximum leverage of 100 to 1. So if you have a debt-based program in your service area or your state, and you think that the risk exposure for that program is less than 1%, then you might be able to include it as an eligible use of your reserve fund. But tariffed on-bill programs have had a superior performance in the field in terms of charge-off rates for reasons that are not a fluke. And as a result, they have a higher leverage number and better performance over time. So if you're thinking about capital efficiency, your reserve fund will burn up faster in a debt-based program than in a tariff-based program. So you need to decide as a program manager whether you will allow debt-based instruments to be insured by your reserve fund, because it will inevitably lead to the reserve fund being depleted faster than if it was committed only to tariff-based terms. Let me explain that. I'm pausing now to explain that piece, just a little bit more detail. In a tariff-based program, the utilities charge-off is not for the entire investment. It's just for the amount of money that it expected to receive that year that it didn't receive in that year. So if you have a 10 or 12 year cost recovery period and Susie Lou leaves town without paying her last bill, and actually she was delinquent for 4 months before that, and it was the dead of winter and you couldn't collect, so on and so forth, and she's run up $1,000 tab on whatever, that would not be possible, but I'm just trying to think of a quick example, friends. But if she's run up a tab and you say, well, I'm not going to get that money back, all right, I'm going to file a claim, you would just be filing the claim for the amount that Susie Lou owed and hadn't paid, and not for all the cost recovery for the future years, because the tariff still applies to that meter. And when the next customer arrives at that meter, they've opted in to living in a place that's been improved. The bills are lower than they otherwise would have been. The savings are still being delivered by the energy efficiency upgrades that haven't broken down. And so the tariff charge remains associated with the meter, and the next customer continues to pay. And so the charge-off is not for all future payments. It's just for the payments that you expected to receive that year that you didn't. And so the claim itself is smaller. If you switch your mind's eye now to a debt-based program, the customer defaults. The loan itself is not transferable to somebody else. The next successor customer can't be forced to take on the debt obligation of a prior resident at that place. You have to write down the entire investment, not just what that customer was unable to pay you for the last 6 months, but actually everything that they would have needed to pay you for the next 6 years. And so the reserve fund will be depleted faster, or it's exposed to more risk to be depleted faster than if it's only for tariffed on-bill programs. And for that reason, this particular state energy office that had given us the permission to share the sample chose that this reserve fund would be exclusively for the use of tariffed on-bill programs. And one of the reasons they used to justify that decision is that they'd had loan-based programs operating in their state for more than a decade. Those programs had never had a reserve fund backed by taxpayer dollars. They were well developed and well managed, and there was no need to add a subsidy to a program that was already performing well without one. So what they did was say, this reserve fund is for tariffed on-bill programs, which are relatively new to our utility executives. We're trying to entice and incentivize utility managers to adopt a program that will actually be open to more customers that have never been served before, and that's what's justifying our use of social funds to socialize the risk of their private investments. I hope that's a helpful reply, even though I know I've extended into a depth of detail that wasn't asked.
No, that was good. Thank you, Holmes. I appreciate the breakdown of that option. So I think we've reached the end of our audience questions at this time, and thank you everybody for fielding such excellent questions for the topic. So now I'll move into my next portion. I want to highlight for those of you who have additional questions or would like to get more into the weeds about your specific needs and interests regarding reserve funds, we will be offering office hours. It's going to be next Thursday from 1 to 2 Eastern Time. This slide will be made available to everybody along with all of the others, so the call-in numbers are available there. I recommend you all to mark a hold on your calendar. It's a good opportunity to get some more in-depth one-on-one kind of assistance from Holmes. And if you have any kind of questions that you want to tee up prior to that, or topics or things you want to know about, please feel free to just email me. And I will make sure that Holmes gets those questions prior so we can be best prepared to assist you in the time. Oh, you know what? And one of the listeners did just point out there is a typo on this slide. It is actually June. So it will be next Thursday, 22nd, not July 22nd. Thank you for catching that. I'll make sure that's corrected on the slides before they go out to everybody. But following that, next month we will be having our next session as part of our inclusive financing series. The next topic is going to be sourcing capital for your tariffed on-bill investment program. So this is definitely a good place for folks to tune in to learn about where does the money come from and how do you get these things started. So we definitely look forward to hosting folks for that. That is going to be on July 6th, so coming up earlier in the month than our usual line of series. That was when we had our folks available. So we'll look at things like what are the different sources of available capital, the associated processes with those, pros and cons, and things you want to think about when considering where to source your capital. So definitely encourage you all to join in for that one. For those of you signed up for the Learning Circle series, you will be receiving your GoToWebinar link early in July. That'll have your calendar invite and login information, and I will make the registration link available when I send out the notes for this session for anybody who isn't signed up for that, so that you can join us as well. And with that, we will go ahead and close out our series. I want to thank Holmes Hummel for all of her excellent information again today, and thank you all for taking the time to join us for this conversation. And if there's anything we can do for you, any additional questions you have, feel free to reach out. Thank you all for attending.